Having a ton of company stock is what most people call a good problem to have. You've worked hard, your company has done well, and now you're sitting on a significant nest egg. But here's the catch. Having too much of your wealth tied up in a single stock is like carrying all of your eggs in one basket. If that basket drops, your retirement plan also drops with it. The problem, selling that company stock usually comes with a massive tax bill. But what if I told you there's a way to diversify your wealth, save thousands of taxes, and support a cause that you truly care about? Let's talk about this financial win-win. Before we begin, I want to remind everybody, please subscribe to our YouTube channel. Hit that subscribe button down in the corner of your screen for more tips and tricks on your personal finances. Strategy number 1 is the simplest. Gift the stock directly to charity and don't give cash anymore. Let's say you have a stock that you bought or vested at, say, $1 per share. Let's say today it's worth $10 per share. If you sold that stock and gifted the cash to charity, you would have to pay capital gains tax on that $9 of profit. But if you gift the shares directly to charity, you get a full tax deduction for the $10 per share that you're gifting, and the charity, because they're tax exempt, can sell the stock for the full $10 per share and not pay any capital gains taxes. You get a full tax deduction for the $10 per share. The charity gets the full fair market value of the stock, and well, the IRS gets nothing. Here's a pro tip. Take the cash that you would have donated and use it to buy a diversified portfolio. You've just traded a risky stock for a safer mix of investments, all without the tax hit. Strategy number 2 is a donor advised fund, or DAF. Think of this as a charitable savings account. You put your stock in the fund today, take an immediate tax deduction for the full fair market value, and then you advise the fund on where to send the money later on. This is a perfect strategy for what we call deduction bunching. If you're in a high tax bracket now, but plan to retire in a few years, you can donate, say, 10 years worth of gifts all at once. You get a massive tax break while your income is high, and the money stays in the fund, potentially growing tax-free for the charity until you're ready to send it out to them. Now, if you have a very large position, you might look at what's called a charitable trust. A charitable remainder trust lets you put stock into the trust, which is then able to sell it tax-free and pay you an income stream for the rest of your life. When you pass away, the remainder of the assets go to charity. On the flip side, there's a charitable leads trust, which gives the charity an income for a set number of years and then passes the remaining assets back to your heirs. Often, this has a huge estate tax benefit and savings. These are more advanced tools, but for the right situation, they are incredibly powerful. Diversifying your wealth doesn't have to mean writing a big check to the IRS. By being strategic with your giving, you can protect your future and make a real impact today. Every situation is unique, especially when it comes to the complex math of taxes and stock options. If you want to see which of these win-win strategies fits your plan, please reach out to us today. Let's run the numbers together. Thanks for watching, and I'll see you next time.